All righty. You see my, let me share my screen. Gotta do that too.
Maybe just the names, I guess. Kim is what on the screen in Discord?
Since this is being recorded, I don't know, because then the whole world will know that I'm Sputnik Kim, so maybe I shouldn't tell you that.
All right, that sounds good.
That was more for the enjoyment of Phil, since he's in IT and security and stuff. He would appreciate all the nonsense.
Well, in that case, I would not.
Well, now the whole world does know that you're Sputnik Kim because that got recorded. All right, let's get started.
Yes.
So in the last class, we went through the options, Greeks, and a little bit about the CDF, the cumulative distribution function. But I promised that we would stop back at Vanna and talk about the Vanna hedge. If you remember right, Vanna is the second derivative, is the second order derivative of the Black-Scholes equation, where it is the partial derivative with respect to the underlying times the partial derivative with respect to implied volatility. So one can say that it is the partial derivative of delta with respect to implied volatility. Okay, those are equivalent. You can also say it's the partial derivative of vega with respect to the underlying. All of that's mathematically equivalent. Vanna measures the sensitivity of your portfolio to both implied volatility and underlying. And if you have a short options portfolio, if you think about the four things that matter: interest rates, time, implied volatility, and change to implied volatility, and then change to the underlying, realistically, only two of those can hurt you. Interest rates, unless you're trading options that have a long period of time, usually don't play into it. Time is always your friend. And so therefore you're susceptible to changes in implied volatility and the underlying for the two pieces that can hurt you. So it would be great to develop one trade to go minimize your exposure to that if you're in a pinch. And I actually did this trade yesterday when the market took a nice dump for us. Saved me a couple percent by the end of the day. I think Deval, I was trying to help you with it, and we just simply ran out of time. But at any rate, remember, Vanna is the sensitivity of your portfolio to both implied volatility and the underlying. And so how do we hedge that? Well, we compute what I call a Vanna hedge. And the two pieces to the Vanna hedge are right here. Need to compute the strike price for the Vanna hedge. And the strike price is the sum of the strike prices times the position value for each option with the same expiration divided by the sum of the position values. Okay, we'll say that again. Pick an expiration, one expiration. Don't do this across multiple expirations because it only works for one. And then after you're done with that one, go to the next one and go to the next one if you've got multiple expirations in your portfolio. You multiply the strike price times the value of that position, okay? The value of the position in terms of dollars. And then you add that to the strike price times the position value for the second position that you may have, and then the third position and the fourth position, until you've finished with all of the puts in that particular expiration. Don't Vanna hedge calls. That doesn't make a whole lot of sense. You want to Vanna hedge only your puts in this particular situation, in this particular instance. So we're only worrying about puts here.
Why is I'm not sure I understand that part of it. Why puts only?
Well, puts are the things
They're short.
You can't. Well, I guess you could Vanna hedge your calls, but you have to do them as calls, only calls. So you can't do calls and puts at the same time. Makes no sense, right?
But if I had puts and calls in my portfolio and I
then
want
you
to
Vanna hedge the calls.
okay,
just
in
the
separate
calls.
Yeah.
Yes.
Yeah.
Yes.
Okay.
Don't do them all at the same time, is what I'm saying.
Yeah.
You have to treat them separately.
Yep.
Okay.
Yeah, but if you had puts and calls, basically you are Vanna hedging for an event, either on the upside or the downside. So you'll only take maybe one side of it, right? When you're Vanna
You
hedging.
would,
Yeah.
I've only Vanna hedged puts ever. The rationale, we'll talk about calls here in a little while, but volatility events tend to be limited to the put side. Okay. To the downside. We don't really discuss a VIX spike when the market moves up 3%. Like yesterday, we had the VIX moved from the prior day low 41%, off of the prior day low to where it closed yesterday. Okay.
Oh, nuts.
You don't get a 41% VIX spike if the market moves up 3%. The VIX
Right.
goes down, right? So Vanna hedging is usually limited to puts. You could do it for calls, but realistically, calls for if you're selling calls, you're really more worried about the delta of the position, not so much the implied volatility, because implied volatility is likely to be working in your favor. Okay.
So-
Whereas for puts, the underlying the change in the underlying and the change in implied volatility works against you. And that's what the Vanna hedge is for. All right. So first we're going to compute the hedge strike price.
On that even hedge strike price calculation, right, Peter? So let's say if I have three positions for June 25th, 6,300, which is trading at $8, 6,200 that is trading at $6, and 6,100 trading at $5. Basically, that's what that formula at the top is, the sum product of all three divided by 8 plus 6 plus 5. That's what.
Well, so it's not times $5. Depends upon how many you have, right? So the position value is all. We're going to go through an example here in a minute.
All right, cool.
All right, that from a real portfolio from over a year ago, but it will show you how this is done. Basically, it's not the value of the put position, it's the value of all of the puts for that position. So for instance, in your example, your 6,300, if you had 10 puts, then it's the value of those 10 puts. That's your position.
Got it.
For your 6,200, if you had 5 puts, then it's the value of those 5 puts. And for your 6,100, if you had 20 of those, then it's the value of the 20. Okay.
Got
That's
it.
what feeds in here. It's the position value, not the value of each put.
Yeah.
Okay.
Yep.
Then the hedge position value is the sum of all of those position values. In other words, that's the total amount of money that you have for that particular expiration, long and short. All right. Let's go through that example. Okay. This is from a year ago. Let me zoom it out a little bit so that we can see it all. Can everybody see that okay?
Yeah.
All right. So this is when we were doing put wall. We had VIX calls in this. We had all kinds of different things going on in this portfolio, but this was actually what one of the funds portfolios look like. And what we're going to do is we're going to Vanna hedge. Yeah, my mouse is misbehaving. Vanna hedge this expiration, January 31st, 2025. These were the positions in it. Note I have long positions in here, right here. Quantity 145, quantity 145. Short positions in there, all of these guys. And we're going to Vanna hedge that all together. So let's take that part, which is represented right up here. Okay. Now let's Vanna hedge it. These are the position vegas that go along with that. Here's the calculation. So the vega of this particular position by itself is 0.007 or 0.077. we're going to multiply that by the number of positions and then times 100, because there's 100 contracts per position. And so basically what we're promising is that we're going to reduce the position delta, which is the sensitivity to the underlying, and the sensitivity to the implied volatility with this one trade, just one trade. So now we're going to take this. This is all these same positions over again. We're going to do the first calculation. Strike price times value. Okay. Can't see A, so let's go scoot that over. Now we need to go minimize this one too. Okay, can you guys still see that okay?
Yeah.
All right. So the strike price is 3,400. The market value is 76,1250. That yields that value right there. Second one, 3,750 times 1160, that value right there, et cetera, et cetera, et cetera. And we come up with a total for all of these positions right down here. Okay. And a hedge strike price is the sum, if you remember right, it was the sum of all of these things divided by the total value, which is right there. Note that that is just simply the value of all of the positions. And we come up with 4712. Well, if you go look through the options chain, you'll realize there's no 4712, but there is a 4710. So let's go through that. This was the January options chain from that particular point in time. Okay. And there is a 4710, and these are the details that go along with it. Here's the bid, the ask, it's theoretical value, it's delta, and it's vega. Okay. So what we want to do is we want to take $44,077.50, multiply that by -1. Okay, because this particular value shows that we're short that amount. Okay, which means we need to be long that amount at 4710. All right. When we do that, we're going to buy 200 4710s for 220. See the January options expiration. Okay, 220. I'm assuming that we can buy 200 options at 220, which doesn't quite split the bid and the ask, but it's closer to the ask. I can usually get that 5 cents. So we're going to assume that. If we look at the position vega for that, here's the particulars over here. We get 88.60 for that new position, and the position delta is 200 for that. If we go add that position to this portfolio up here, our net position vega then becomes the sum of this and this to yield 42.3. And our position delta becomes the sum of this and this to become -13.7. So we're very, 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 very slightly short on this expiration as shown by the position delta. And we have almost no sensitivity whatsoever to implied volatility anymore. We went from this for this expiration, and I need to get a new mouse. Okay. These underlying characteristics for vega and delta to this with that one trade. That basically desensitized that particular expiration to the things that can hurt us in the market. Now, if I've got multiple expirations, let's go back to the actual portfolio, and you can see that I do. Okay, I've got this particular position, got the 29th in there, got some positions at the 24th, et cetera, et cetera. Note for the 17th, I have a call. I would exclude him. call isn't included in the calculation, unless I was just doing calls. So I'd have to go through and Vanna hedge each of these particular expirations. Okay. But this one right here was the biggest one. So I would do it first. Any questions on this?
I do. I had a couple as we went. So market value, is that a real time price? Is that fluctuating through the day? How?
Which you mean right here?
Market value, column H.
That one? Yes, that changes every time the options price changes.
Okay, so,
So
you're gonna
So
try
this
to
is
capture
this
real
is a
time.
picture. This is a picture in time,
Exactly.
right? So and that picture in time matters. You know,
So you want to execute it close to that value, because if it's moving and you wait a half hour, you may not be hedged like
if you wait a half hour, you need to go recompute this.
Yeah,
This is meant to be something that happens within 30 seconds or quicker if you can. Like for us, I download my portfolio into a program and then we compute it. And then I execute the few trades that I need. Yesterday for me, this was one trade. In a lot of cases, notice that I have a bunch of different expirations here. That makes this hard, okay? If you have that situation, then pick the ones that have the most value. This has far more value than any other portion of my book. This would be second. So I would do the 31st first, the 24th second, and then the rest of this is almost don't care, right? In terms of value. Following me?
Mm.
Do
Yep.
the biggest first, then do the second biggest if you don't have the time. And don't be afraid to recompute it. Let's say, for instance, that you Vanna hedged it into a volatile market and you did it one time and you're not happy with it. Then do it again. Okay. You have at least some protection in there. You may find out that maybe you overprotected the portfolio and or at least part of it, one of the expirations, and maybe another one you underprotected it. But do the calculation again and decide at that particular point in time whether or not there's an alteration that needs to be made. Okay. The key to this, of course, the beauty of this is all static. Everything is one point in time. We don't have any rush because our prices on this spreadsheet don't move, but in reality they do. But you can see the impact of what happens to your portfolio with this one simple trade.
Yes.
Deval, you run the grind. I would suggest that you go build a spreadsheet that can do this sort of thing for you, where you can pop your portfolio in there and have this calculated really quickly by expiration, and then you rather than sit here and have to do it by hand or download it to a spreadsheet and figure it out in real time. You don't want to spend that kind of time. You want to have this done well in advance and understand how your tool is going to work, and then pop out the few things that you need, put them in, like our sorts in order. The one that we have, the program that we have gives me the biggest one first,
Mm-hmm.
the largest dollar value expiration first to the smallest one.
Yeah.
That's how we've organized it. And if I can't finish the whole thing because I ran out of time for the day or something like that, I still want to get the biggest ones first. That's where my most risk is.
Yeah.
Okay.
Absolutely makes sense. I have some thoughts on how I can work and automate some of that in my portfolio.
The beauty of it is if you give Claude good enough directions, or Gemini nowadays, it'll do it for you.
Yeah.
The days of having to write code are diminishing, if you will.
Right code. What's that?
Yeah, well,
I use
that's the thing that all of the ancients used to do with, and people like gray hair like myself did, if you will.
ancient from 3 years ago.
Yeah, it wasn't that long ago, actually.
No, less than a year.
Yeah. So quick question, right? So Peter, so basically you're spending $44,000 to protect current 44,000 and potential for a lot more loss if we're to have an event. That's what that is. And then on Monday, you would basically close out this position at market open if nothing has done significantly, right?
Yeah. So you've got two ways of thinking about it. Okay. In my particular case, I had a partial liquidation on the account that I Vanna hedged the rest of it with. I'm glad I did because the market only went down more after I Vanna hedged it. Saved me probably 2% of value. So I have the choice now of deciding that I already liquidated the portfolio because that's essentially what the Vanna hedge does, right?
Mm.
The only way I can reduce these values further if I simply eliminated all of these positions, right?
Yeah.
Then my position vega for this expiration and my position delta would be 0 for both if I had no positions. That's what liquidation does. It means that you don't have any vega or delta for those. But my Vanna hedge essentially already did that.
Yeah.
This is close enough to 0. You know, it says, yeah, there's some exposure there, but it's really, 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 really small. In fact, it's less than what one position would normally look like, right? So, and by position, I mean one of these guys up here. So it's not, there's nothing that is that risky. I can say, I have the choice going into Monday of saying, I already liquidated and I'm going to start over. And I don't want to remove my Vanna hedge and just leave those in the portfolio until they expire. That's one option.
Mm-hmm.
The second option, as you said, is if the market moves higher and I've made the decision that, well, okay, I want back. I want to regain some of this value here that I had. Well, then I can take the Vanna hedge off. Yes, I did lose some money in the process. But losing some money in the process is much better than potentially having a catastrophic event Monday morning when I can't do anything about it and having this blow up by a factor of 10. Okay. So that's what the trade here, so to speak, is. But what I've done is I've left myself with options. I have options. I can choose to say, well, now I actually liquidated my entire portfolio because I believe that the Vanna hedge, I'm going to leave the Vanna hedge on and just let all of these positions now expire worthless in the future. Okay. That's my assumption that they will. And I'm okay with moving forward from that position. That's one option, option A. Option B is to then take off the Vanna hedge. I even have a third one. Essentially, if I add this 4710 position in here, that we talked about with this value, what I've realistically done is I've turned this entire expiration into a series of verticals. Got a 47, 4740
Right.
to 4710, a 4710 to 4700, 4710 to 4680, 4710 to 4100, etc. And then these two positions down here at the bottom, they're long. Right, they were there to help hedge this whole thing out. I've essentially taken all of those shorts and turned them into one big vertical with 2 extra positions at the trailing end of it. Okay, it's kind of what happened here. Note if we took these 2 out, we didn't have these positions, right? We said that we didn't have those. Let's just go virtually take them out.
Your cost of Vanna should go up, right, hedge? Yeah.
Know what happened to my Vega?
Yeah.
Okay. This went up, so I need to actually buy more than 200 now, right? We could figure that out. Number I need to buy is
63, basically 300.
Divided by 220. Need to buy 287. We're here to 287.
Oh.
And my position vega is a little bit higher than it was. The delta is still pretty low. Okay. But it's still, significantly better than what it was over here. I think what we may have wanted to do here was probably round this up a little bit, changed it a little bit. Why did my strike price change? What was that? What did I do wrong? H21. I don't have an H21. Oh, N21. N21. What is N21? Right there. I see. I didn't take them out of here. I need to do that too.
By the way, Peter, is this spreadsheet on the
Yes.
data folder?
This spreadsheet, the Vanna Hedge example and the options chain values are on the Discord in the information and instruction thread.
Got it. Thank you.
So 4378 is what we have. So that's what we would actually have had to use. We can go look that up. That'd be 4380 if there is one. 4375. So we probably want to do that at $1.55. I'm not going to go alter it all the way through there, but you kind of get this sense of what we would actually have to go do. And again, this would minimize this particular position and this particular position with those other. Note that the strike price changed because we eliminated these. Okay.
Question.
Yes.
You have your delta hedge in here, but that's a byproduct of this. You weren't driving your decisions here, the quantity, blah, 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 based on how you were going to end up from a position delta, right? That's just a byproduct. Is that something that you could see the number there and go, oh shit, I'm too short? Explain to me why you're putting delta on this spreadsheet. I guess maybe that's
well, because Vanna is, so remember, this is a Vanna hedge.
Yep.
And Vanna is the sensitivity of the portfolio to both the underlying, the delta, and the implied volatility.
Yeah. Okay.
And what we're trying to do is find one trade that can minimize both of those for one expiration. Right. And that's what this is doing.
Okay.
So that's why delta. So delta is the portfolio position with respect to the underlying, and Vega is the portfolio position with respect to implied volatility. And so if Vanna is the measure of both of those together, a Vanna hedge should therefore minimize both of those.
Right. So it naturally follows that you expect that delta should get close to neutral as well.
That's right.
Gotcha.
That's exact. And I want to do that with one trade. That's the key. I don't want to have a Vega hedge and a delta hedge. I want to have one trade that does both.
Right.
Because again, think about yesterday. The market was moving rather quickly. Volatility was all over the place. This is in the afternoon when things were starting to get kind of ugly. And that's always when you're going to put this on. You're not doing this in a calm market. You're putting this on when things are ugly. And so, Phil, you had mentioned that 30-minute thing. What happened 30 minutes ago is no longer applicable to now. What happened 30 seconds ago may not be applicable to what is happening now. I need to be able to do this inside of 15 seconds or 10 seconds as soon as I possibly can. And so that's the value of this sort of hedge, is that it's quick. I use for liquidation, I use bid stop losses. That's a different animal, but this is something that if you don't have a bid stop loss on and you need to go hedge your portfolio relatively quickly, then this is how you would go about it.
Yeah.
There is one more key thing that goes along with this, and it's a key assumption. The key assumption is that the underlying market is way above these strike prices for the puts. Okay. Remember, when I'm adding in the Vanna hedge position, I'm essentially just turning everything into a vertical. So once that happens, this acts like vertical spreads. This expiration. So if the market moves down to being somewhere close to, say, this particular strike price, 47.40, and I have a 47.20 or 47.10 behind it, that 30-point difference can show up. In other words, these will change, right? If the market moves down there. This is with the market way away is where, so you have to still monitor these positions if you leave this on. The last time that I remember having an issue with a Vanna hedge, in fact, I think it's the only time I've ever had an issue with a Vanna hedge that I left on, was Liberation Day last year. Vanna hedged part of the portfolio on April 3rd, part that didn't get liquidated. And by April 7th, we were there. These were near the money options. And you have to deal with them then as near the money verticals. Okay. So just be aware of that fact that the Vanna hedge is great until the market moves down to where these become near the money. All right. Any questions?
So you mentioned about, we know going back in history with the Discord that you tried to put wall, you tried UVXY. I mean, you could think about UVXY as kind of being a hedge, right? I'm going to hedge. I'm going to buy UVXY. It doesn't quite have that relationship. But this still hasn't putting a Vanna hedge on, triggering to put a Vanna hedge on, still hasn't fully replaced the end game target, which is to isolate yourself from VIX spikes and the large portfolio liquidations, right? There's still not this hasn't completely replaced the idea, although you don't do it anymore, the UVXY, because in the end, what you're doing with your portfolio is trying to hedge against those VIX spikes of August 2024, Liberation Day, whatever the hell it was, right? And this doesn't necessarily replace that. I'm just trying to see how this fits in with that big scheme of what you've been trying to do over the last year.
Well, let's look at it from a VIX spike perspective here. Let me go undo all of this, all my changes. Okay. So that value right there represents sensitivity to implied volatility, right?
Yep.
And the fact that I'm negative means that it's negative implies that I'm actually short implied volatility.
Yep.
Okay. If it was positive, I'd be long implied volatility. By adding the Vanna hedge, I have significantly desensitized that portfolio by about a factor of 20 to 1. You agree with that?
Yeah.
In fact, I actually made it slightly long volatility with that one Vanna hedge.
And that was kind of my follow-up question, but keep going. Yeah.
So yeah, it does desensitize the portfolio to that big spike. Could I have some loss due to machinations in the rest of the portfolio or other things like that? Sure. Remember, it's supposed to be 47.12.2023, and not really, and it's not really 200 positions that I'm supposed to buy, because probably 200 and something else or whatnot to get these to be exactly zero. So this is an approximation to perfect, if you will. And perfect would be that I didn't have the positions at all. So in other words, they were fully gone. Because that's the ultimate in desensitizing your portfolio.
Yeah.
But this is my portfolio didn't liquidate. It's 3:45 on Friday afternoon. I don't want to carry the risk over the weekend. What should I do? Do a Vanna hedge on what's left. That's essentially what I do.
It does kind of replace that concept of I'm going to buy UVXY.
Oh, it's significantly. The beauty of replacing UVXY naturally loses money all the time. Okay?
Right.
And you have to account for that. That was part. This is just a I don't feel good about going into the weekend with my portfolio as it is. Let me go put one trade on that I can take off on Monday, choose not to take off on Monday. In other words, I'm giving myself all kinds of optionality going into the weekend. The way my portfolio going into next week actually is, some of them got fully liquidated. They have no risk whatsoever. Doesn't matter what happens on Monday. They won't make money, lose money, or anything else. They're just zero. They're going to go into next week with an empty slate. In the case of the one that got Vanna hedged because it didn't get completely liquidated, it actually would profit. It's got a positive vega and a negative delta. So that if we go into next week with a big VIX spike, it will make money.
Well, that was my next question. You could, if you were confident, you could Vanna hedge to go stronger into the long position, but then again, you might say that
if you were that confident, I would tell you the best trade to go do is liquidate all of this, get rid of all of this, and then go buy straight puts.
Yeah, right. True. Okay.
If you knew that, what this is saying, I don't know, but I don't want to take the risk. I don't like this, but I'm okay with this.
It's kind of like analogous to Darius Dale when he says, you're not going to avoid, what does he call it? Level one, or factor one, but those second factor.
Yeah.
Long tail cut off. That's what kills you. And that's kind of what you're saying here.
That's right. If you, and again, this Vega hedge, I only put it on at the end of the day, right? I can't trade over the weekend. I can't trade in the pre-market on Monday. And that's when, so if something blows up over the weekend, I'm stuck with my portfolio until the market open. And those are always killers. When you can't trade in the market and the market is moving against your positions, and you can't do anything about it except watch, that's horrible. Put this on. I would not have put a Vega hedge on at noon, for instance. This went on at 3:36 or something in the afternoon. I put it on at 3:36 because we had that small spike up above 7,400. I think we got 7,405. That's when I stuck my Vega hedge on for the parts of the portfolio that had not yet liquidated, and it just happened to be all on the same expiration. That does bring up one more thing, Duval, for you or anybody that runs the grind. Note all of these different expirations I got in here. This is a mess. Okay. I don't do that so much anymore. There's a handful of different reasons. We have to, because we trade fairly large amounts, we try to go make each of the accounts that we have expirations on a day of the week. Okay. So one would do only Fridays, one would do only Thursdays, one would do only Wednesdays, one would do only Tuesdays. But what it does is it concentrates your positions into a smaller number of expirations. Tends to do that. Okay. And because it tends to do that, it becomes, that whole portfolio then becomes easier to Vanna hedge. You may have only one or two expirations to deal with instead of all of this mess. Even though there are only really two of them that matter. This one and that one. Okay.
So you're saying basically today I'm opening every day. So then I generally I end up with like 5 to 6 expirations in my grind.
Yeah. And so now you got to think about, I have to compute a Vanna hedge for all of those. In some cases, if you only have one position, the Vanna hedge tells you to go eliminate that position, which is the same thing as a liquidation. But that sort of defeats the purpose then. And you then turn it into a vertical spread instead, is kind of what you would end up doing with that. But you have to then make 5 trades. You have to compute them and then you have to make them. And doing that with the market moving around rapidly sometimes can be difficult. Whereas if you only had to make one, you as an individual only have to concentrate on getting that one trade off. And then if you don't like what the result was, you go back and you recompute the Vanna hedge with that trade in there, and see if there's an alteration you need to make. That's much simpler than trying to go look through a mess like this.
And just to be clear, you can only group on the same expiration day. So that's kind of
well, if you think about it, it makes no sense. So if I was doing the 24th and the 31st, what's the expiration for that's going to Vanna hedge both of those? In the middle somewhere?
An average? I don't know. Yeah.
Well, if you pick this by the 31st, it's gone.
Right. Yep.
Yeah.
So you want, in other words, to do your Vanna hedge, you need to make the theta component the same as the things that you're trying to hedge.
So on that previous comment, so you basically now running more concentrated towards fewer expirations. Is that how you're?
Well, it's an artifact of it's an artifact of liquidation. When you want to liquidate, you don't want, think of it as the crowd trying to rush for the exit. Okay. If I have 5 portfolios that all have the same, the same strike prices and expirations, they're all going to want to get out at about the same point in time. That's just the way that our stuff sort of works. And so I don't want to have a concentration of positions that all fire off and cause this huge spread in the bid and the ask, because I'm asking to go get out of a lot of liquidity with the same option, right? So if I do it, if I set one portfolio up to only trade on Fridays, one to set up only for Thursdays, one for only Wednesdays, there's no conflict between them on when they get out. Each gets out on, in other words, I'm not sharing expiration or sharing strike prices between multiple different portfolios. We did that just because of size.
Yeah.
Okay.
Yes. So then when I said I have 4 to 5 different expirations, while I understand it, but that's kind of what you're replicating through 5 different portfolios, right?
Yeah, but each is their own animal. In other words, the Vega hedge, or what the liquidation point that I have for one that only trades on Thursdays, it's not going to conflict with the one that only trades on Fridays.
Got it. Yeah. Okay. That makes sense then.
Think of it this way. See that? That's 291 positions. This is a relatively small portfolio. Let's multiply that by 30. And then let's multiply that by 5. That's a lot of positions to liquidate on a market order.
Yeah.
You wouldn't do that. You just wouldn't do that. That's not going to be what you're going to go do. You're not going to try to you're going to get killed on that market order. Okay. So that's why we do that. It's an accident. It's an accident of portfolio construction, as opposed to thought about relative to a Vanna hedge or other things. Any questions on this? We've spent a lot of time on this now. It is important. But if you have more questions, let's go make sure that everybody understands this. This is an important concept for having a multi-option portfolio set. Like, I know, Deval, you have this for the grind.
Yeah.
And this is a very important end of the day type tool to avoid potential catastrophe the following morning.
I guess going back to your comment and discussion earlier on, you could buy puts and to hedge your portfolio as well, right? Even if you're only looking to make it neutral. Okay. Is there a particular reason why you would favor Vanna hedging over, I'm going to calculate and buy puts across, even if it's just SPX or something and not completely reflective of what you have in your portfolio? You know,
Well,
you
let's-
also hear about New York 13 and DL, you know, with hedging with futures. I don't even want to think about that, but I'm just curious on, you know, your thought process in regards.
Well, remember what the goal is. I want to desensitize my portfolio. I want to make one trade that desensitizes my portfolio, or at least a given expiration in my portfolio to implied volatility and underlying. Those are the only two things that can hurt my short option portfolio, right? One trade does that.
Okay. So the simplicity that it's very calculated in terms of making it neutral, or
Yep.
like you said, a
Making
little
it, and that's actually the key word, making it neutral. You hit upon a key word. I'm making the portfolio neutral. I'm desensitizing it to those two parameters, making it neutral.
Yeah.
I'm saying I don't want to play anymore. I stop. I don't have time to go liquidate 6 or 7 positions. What's one trade that fixes all of this?
Yeah. Okay.
Peter, what you normally do with those hedges? You let it expire worthless, or you like when market recover, you like just like clean them? So my issue is like I have no issue buying the hedge, but I always don't know when to like remove them.
Well, so let's as I mentioned kind of earlier, with the Vanna hedge on, I have options, right? So the following morning, if the market takes a big dump, the long position that I just put on with my Vanna hedge will go up in value while all the shorts will go down, right?
Yeah.
I could choose to take my profit on the long position, but now I'm exposed again with the shorts. Choose to do that. That's one option. Okay. I can choose to potentially go through and then liquidate the particular expiration through a series of closing vertical spreads. I can do that.
Mm-hmm.
I can choose to do nothing, which is probably what I would end up doing. Nothing, just because, and checking to just make sure that I'm still desensitized to implied volatility in the underlying. And if I am, then I don't have to do anything. If the market moves higher, I can choose to take the hedge off, and then expose myself back to the short positions that I originally had and was okay with, and choose to do that if I wish. I can again still choose to do nothing and say that, well, I'm not going to play with those old positions because the volatility regime that they were taken under is no longer applicable.
Mm-hmm.
Vanna hedging gives you options.
Yeah.
It doesn't. It oftentimes what's best is to leave it alone once you've Vanna hedged it. And the rationale for why I say that, let's go to Monday. Okay. Thursday, the VIX closed at 1580, I think, and the low of that day was 1514. Okay, on Thursday, 2 days ago. On Friday, the VIX closed at 21.5. 15 is not the same VIX regime that 21.5 is.
Yeah. And
I don't want to necessarily carry 15 positions that were taken when they were 15 and try to get them to live through when in my particular case, these were June 26 positions. I got to carry them for 3 weeks still and get them to the finish line. Whereas with the Vanna hedge, they're already covered. I don't have to worry about them. I can start over. I can find, if the VIX remains high next week, say it's in the 20s again, I can ignore those positions that are out there that I don't like anymore at June 26th, and I can start taking positions that have less risk in shorter periods of time and start messing with that. That's what I would probably prefer to do. If we get a really, really, really big VIX spike, see these positions here?
Mhm.
These are all long.
Oh yeah.
Okay, see those? You know what happens if the VIX spikes to call it 60 on Monday for these
Oh,
these
yeah.
kind of positions?
Maybe $10.
This won't be 10 to 15 cents. This will be 10 to $12.
Yeah.
I
saw
have
that.
some of those. I kept some of those on my on for this one portfolio that I've hedged. Those will print. Then I'll sell all of those. Go look at my Vanna hedge again, decide whether or not I want to go just eliminate all of those positions through again verticals, or whether or not I want to keep what I've got there, and then I'll go trade. But by Vanna hedging that particular portion of the portfolio, I'm not worried about the VIX spike. I've set myself up to profit from it. Be happy if it happens. My luck, it won't, because that I never get that kind of thing when I'm positioned for it. But one of these days, it's gonna. And I don't have to worry about the remaining short positions that I have, because they're relatively insensitive too. In fact, I know that I did go look at that this morning when I did my stuff. My Vega for the options that are there is positive, so they would actually increase in value. That expiration would actually increase slightly in value too, with a big spike.
Yeah, makes sense. Yeah. Yes, thank you. Yeah, I never tried Vanna hedge, but I tried the margin curve control. That helped actually, really. I also I let it expire, and normally it gives you a little bit perfect actually. Normally, yeah.
All right, guys. Any other questions?
Good stuff.
We're going to wrap this right here. Just because we're pretty close to our hour in. Let me get to here. I'll stop sharing my screen. Next class, we'll start up with we'll start up with the discrimination piece where we left off from before. If you guys have any other questions about Vanna hedge or anything like that, just go ask me in the Discord, or you can bring it up again in the next class. But this one, this one turned out to be a Vanna hedge class, so that's fine. Any other things?
Thanks for your time, Peter.
All right,
thank you, Peter.
You guys have a good weekend. I will talk to you soon.
See you, everyone.
Have a good weekend.